The chart that I'm about to show you in this video might be one of the most important charts that you could see when it comes to where are you going to put your capital over the next decade or so. If you have a long-term mindset, where is the best place to put your capital? And I'm going to explain this, but let me put this chart on the screen right now. This chart is showing the S&P 500 forward PE ratios in subsequent 10-year returns. And the green line is where we are right now. The S&P 500 has a 23x price earnings ratio. If you combine all the companies, average out their ratios, that is where we are, 23x. And when you see the annualized returns based off of in the past when we have had a 23x PE ratio, what you'll see on this chart is that the best case scenario is a 2% annualized return, and the worst case scenario is a minus 2% for within a 10-year window. So on average, with a 23x PE ratio, you should be expecting at best 2% annual returns on your investment portfolio. Now, that is an average that accounts for all the S&P 500. There will certainly be value companies, and there will certainly be companies that are overvalued. But that should be a little bit alarming to you as far as like, oh no, that certainly does not keep up with inflation. So I want to flesh this out and explain to you some things that where this has my mind rolling as to where I'm going to put my capital and what I should expect moving forward with stocks. So the first point I want to make is a slightly contrarian take, and that is simply this. I think 10 years from now, the average annualized return is going to be more than 2% a year. But is that necessarily a good thing? I would say not. And it has to do with the fact that this time with 23x PE ratios, the mindset is a little bit different after the great debasement of 2020. What I mean by that, we had the COVID crash, and then we had this massive injection of trillions of dollars that led to all that inflation, led to all the insanity, and then the subsequent dump after that, the 2022, don't call it a recession. And we are in a phase of time, I believe, where trust in the dollar is much lower than it's been in the past. And the dollar fundamentally is a different asset than it was in the past. So if you're not going to invest in stocks, an easy place historically to remove your capital and put your capital into was just simply the dollar or treasuries, and getting a very minimal return on your treasuries while you were riding out stock markets not doing well. But at this point in time in 2026, I don't think that most people consider the US dollar a viable option as far as parking their capital. They know that over a 10-year period that their purchasing power with those dollars would decrease. So most people are going to want to put it somewhere. And I think the mindset is that generally it's just going to be a lot of people are just going to keep their net worth in the stock market. It's like, I can't put it in dollars. I might as well put it in the stock market. So that's my first thought. The second thought has to do with, okay, where would be, I guess this is, I gave you two thoughts with those first two, those thoughts there. There has to be a bull run somewhere is my third thought. And where's the bull run going to be? Now, I'm a crypto guy. Does that mean I believe that crypto is going to have this big explosive 10-year period? I don't know. It's take it or leave it. I mean, if you look at the last 15 years for crypto, it's been a very good 15 years. So my tendency would be to think that crypto may, and I don't know if I want to include Bitcoin in this, is crypto in general may be in line with stocks more than with wherever else we're going to find that bull run. But there is a very obvious answer for, all right, what is going to do well over the next decade? If we're expecting 2% annual returns, maybe a little higher than that, a level that does not keep up with inflation with the S&P 500, where can we look and find the returns, the big bull run? For me, the answer is glaringly obvious, and that is in commodities. Now, some caveats with that. We have seen over the last couple years a massive move in gold and in silver. We're seeing oil starting to get heated up. So if we're talking about 2026, I wouldn't be surprised if the S&P 500 and crypto outperformed commodities in 2026, maybe even in 2027. But if we're talking about the next 10 years, commodities are very likely, in my opinion, to outperform the stock market. So we have seen, if you were to see a gold chart, an S&P 500 or NASDAQ chart priced in gold, what you would see is that the peak for the S&P 500 and the NASDAQ was in November of 2021. And we've seen what, if this was measured in dollars, what a lot of people would call depression level correction here in the price of gold. Okay, but because we're measuring everything in dollars, the stock market has been going up, even though the peak for the S&P 500 and NASDAQ priced in gold was in 2021. So now that we've had this big run already in gold and in silver and in other commodities, I wouldn't be surprised if there was some kind of a dead cat bounce or a move to a lower high with the S&P 500 and the NASDAQ in their gold valuations, but then we would see a move down to even lower levels. If you got to think about this, just there's always been these rotations between the stock market outperforming and then commodities outperforming. We've seen the stock market do very well since when? About, bottom was March of 2009 for the S&P 500, the NASDAQ, and the Dow Jones. Ever since 2009, we've had a big run. It's been about 17 years. Okay. So before then, though, we saw commodities do very well from about the dot-com bust to 2011. I think it was May of 2011. We saw gold and silver, a lot of commodities do very well. And then stocks took center stage. Before commodities did well, we had the 90s, the roaring 90s, the dot-com boom. And that was about a 2-decade period of stocks outperforming commodities. Before then, we had the 70s leading to the big peak in 1980, where gold and silver, again, did very well with some periods of consolidation. And so the rotation has already begun. I think we're about 25 to 35% of the way through this rotation, where we're going to see gold and silver and oil, unfortunately, outperform, and whatever else, copper, platinum, things like that. They are going to outperform the stock market, and the stock market in its gold or silver valuation is going to underperform. And so this is where I'm seeing opportunity moving forward. My portfolio right now, it was pretty heavy in gold and silver miners at one point. When they all spiked up, I sold all of it. I do not have any gold no, that's not true. I don't have any miners anymore. I sold all my miner stocks, and I have a little bit of gold, a little bit of silver, and there will be a time that I reload. Right now, I'm pretty heavy in oil. I would say my portfolio is about 15 to 20% in oil stocks. And my intention over the next few years here is to be much heavier in oil and in gold and silver and in miners. And so that's my plan for the next decade or so. And then I wouldn't be surprised at all if we saw a big rotation back to stocks. But we really shouldn't expect, we could expect something significant to happen over the next year or so, sure. But we really shouldn't expect the stock market to outperform commodities. That's my takeaway from this chart that you've seen, 23x, 2% annualized returns at best. But I'd love to know your thoughts. Let me know in the comment section of this video.